Today I want to talk to you a little bit about different income types and the impact that has on underwriting, whether or not you get approved for a loan, what kind of documentation they're required, what kind of history, what impact do recent trends in your income have on underwriting. And so we're going to look at these, really quickly here. This is going to be a quick little overview. But first of all, let's get rid of one of the myths is that most people or a lot of people think that you have to have 2 years in some sort of a job before you can apply for a mortgage. And that may be true in some situations, but it's not a generalization that holds up, for example, if you have salaried income. And that's really kind of the most stable, predictable type of income. And if you have a job and it's a salary job where the amount is knowable and guaranteed from month to month to month, generally you can start using that right away. So you can kind of see here, we're going to look at the history. Is there any kind of a history required depending on your income type? We're going to look at the trend. What impact do recent trends have on your income type? And then finally, can we use future income? Can we use a job offer? Can we use a scheduled job, salary increase? So we're going to look at those things depending on the type of income you have. We're going to start out with just salary. So we've already mentioned generally, you don't need a history. Now, underwriting is going to ask for history, and a lot of times it'll be college, for example. If you don't have work history, college history counts as that history, or even jobs you had in high school. They're going to want to record that, but it's not necessarily required. If you have income that's guaranteed, it's salaried, it's fixed, they can generally use that right away, even if you don't have a long history or much history at all with that type of income. Now, they may scrutinize sharp increases. Let's say, if it's your first job and it's reasonable in light of the industry you're in, that there's nothing to compare it to, right? There's no increase. It is what it is. It's brand new. But let's say you have a salary job and you go from $50,000 a year to $90,000 a year in one pay increment. They're going to know why. And basically, with all of these things, my motto is, if it's true, underwriting questions are few. If you've got a story that makes sense and it's true, then that's generally going to support that. So it's nothing to worry about, just to be aware of. They may ask, how did you go from 50 to 90 in one year? So how did you do that? And then future income is allowed. You can be out of college and have a job offer. And under certain circumstances, you can get approved for the mortgage, close on your loan, have the house before you get your first paycheck. So just inquire about the specifics of that. Fannie and Freddie are a little bit different there. Hourly guaranteed is treated a lot like salary. Now, one of the big differences here is, first of all, future income is not allowed. If you're hourly and not salaried, future income is not allowed. So you have to be presently making whatever they're going to use for underwriting purposes. But otherwise, it's for all intents and purposes treated like a salary, except that you will need to have an explicit guarantee of hours. And when you have a salary, the guarantee of the same amount monthly is there. It's explicit, it's implicit, it's there. With hourly, understand that expecting you to work 40 hours a week and then guaranteeing you 40 hours a week are different things. And underwriting is going to require, if you have an hourly job and you don't have a history of working that job, they're going to require a written guarantee that you are whatever number of hours that is. It could be 30, it could be 40, but you're going to need that explicitly written in order to use that. And then again, you cannot use salary, future salary increases for present underwriting purposes. And then sharp increases, again, will be carefully scrutinized. Decreases will be more scrutinized than if it were a salary. If you have a salary and your salary goes down, usually there's a basic explanation. But if your hours go down, that's going to cause a little bit more concern. So just be prepared to explain those things. Now, hourly variable, we're getting into these more variable income types, and they're generally going to require a 1 to 2 year period. 2 years is really kind of what they like to see. A 1 year will sometimes be allowed, but be prepared to demonstrate why 1 year is sufficient history to demonstrate the future predictability of that income. And it's really going to be facts and circumstances. What are your specific circumstances? Why can you expect to continue earning the income you've been earning? Also understand that with variable income, recent history, the trend is way more important than if you have guaranteed salary. If you have a guaranteed salary, there's not generally going to be a concern about that. It's just, it is what it is. That if it goes down, for example, in a particular month while you're in underwriting, there'll be an explanation for that, but that's the new guarantee. Whereas if you're in a variable income and they see it going down, the underwriter is going to be concerned with where's the bottom? Is this the bottom of where it goes and then it goes back up? Does it go to this level now and does it stay there, or is it going to keep going down? So be very careful about protecting that level of income when you're in underwriting and up until the time you close, and when you're working variable income. And that can be true, of hourly variable, commission, second job. All of those would fall into that same sort of category, where if all of a sudden you've got a 2-year history and your variable hours are up at a certain level, and then all of a sudden in the month leading up to buying the house, your hours go down or your commission goes down, they're going to want an explanation of that. And you may be at risk of having your overall income reduced, not just by saying, well, I have 1 month on that 24-month history that's going to drop the average. They're going to look at that 1 month and say, well, that's all we can use now, assuming you can justify that it's not going to keep on going down, because now we think that represents a general trend or a step down that's going to be stabilized. So just be aware of that. Trends are more important with variable income. And then in all of these variable types of income here, as you can see, all of these future income increases, no matter how explicit they are, no matter if they're written, they're not going to be respected until you're actually earning that for purposes of underwriting. And so, 1 to 2 year history, 2 years is preferable for hourly variable. Commission income, you generally want a 2 year. Another thing about commission income is, sometimes the best case scenario is it's the same exact company, you're selling the same product line and you get commissions, and you have a 2 year history of building up to that, and your most recent history is consistent with that 2 year history. That's kind of the ideal case scenario. If it's going down, again, they're going to be concerned about that. They're going to want to evaluate the trend, have it explain why that doesn't represent something that's going to continue to go down, or what the new normal will be, so they can use that. If you change jobs, if you go from one industry to another, you may not get to use that history of earning a commission because you're in a brand new industry, and that may not port over. That history may not necessarily suggest that you're going to be able to maintain that level of income over the next couple of years. So just be aware of that. With commission income, bonus income, same sort of thing. If you go from one company to another, you may have a 3-year history, and maybe you're in copier sales, and you went from one copy sales company to another copier sales company, and they have the same bonus structure. You've got a contract that says it's identical to the other one. You still may have a problem using that bonus income because you have a different company now and the experience may be different. So just be aware of that. 2-year history is ideal. Increases and decreases will be scrutinized in bonus income. Usually that's going to be averaged over at least a 2-year period. But if you have declining income, then again, be prepared to defend that it's going to continue at all, so that they'll use some of it, but also be prepared for them to use just the most recent evidence of the lower income level instead of the average that's going to be higher if you see that happening. Second job, you have to have a 2-year history. That's that's generally kind of a bright line. You have to have a 2-year history with both jobs. And so let's say that you're a teacher and you're also a fisherman in the summer. If you have been teaching for 5 years and then last summer you went fishing and you made $15,000, if that's the first summer that you had that second job, then you're not going to be able to use that income typically for qualifying purposes. Now, if you've been doing both jobs for 2 years, then that's probably going to be okay. You can use that. Of course, you'll need to verify that that income is still available, even if it's seasonal. It doesn't mean you have to be earning it at the time you're being underwritten. Fishing, of course, only happens during certain seasons. But you do have to document that job is still available to you. Unions are an interesting thing because a lot of times you work for a union and then you'll do multiple different companies. And I've seen clients with 7 or 8 W-2s because they're with a union and they do different jobs over the course of a year. And that's okay. That's essentially treated like hourly variable. All these different companies isn't treated like, oh, this person can't keep a job. They keep switching jobs. That's the nature of a union. You work for multiple different jobs. Now, not everybody does, right? If you've been working for the same big project for a couple of years, same company, that's great. But it doesn't have to be that way. It's a little stickier to document because instead of 1 W-2, you've got 7 or 8 of them each year. And just be prepared to do that, or year-to-date pay stubs from each job. Let's say it's November and you've worked 8 different jobs. We don't have W-2s for the current year yet, because we're still in it, but we need to show the history that yes, I still work those 7 or 8 jobs, different jobs, and here's the income. So it's a little bit trickier to document, but it's usable. Alimony, if you have alimony income, there's a 6-month history required and a 3-year continuance typically. FHA and VA I think only require 3-month history, but understand here that if you have alimony for anything less than 42 months, generally it's not going to be usable to qualify, right? Because you have to wait for 6 months of receipt before you can use it as income. So 6 months have expired, and then when you go to underwriting, you have to have 3 years left on that. So typically you should expect to have at least 3 years remaining and 6 months history when you go to qualify with alimony income. Trends aren't going to be important. They will require you to prove that that's being paid, not just that it's in the decree that you're supposed to get it, but that it's actually being paid. But then trends won't really matter as long as it matches the decree. Even if it's stepped down, it was going to be this amount per month, and then it's going to go down to this amount per month. As long as it's per the decree, they'll use whatever that is without worrying about, is it going to go away entirely? And then retirement income, typically 1 month history is all you need. You do typically have to be retirement age to use retirement income to qualify. And retirement income can be very flexible. For example, if you have an IRA that's self-directed and you have $300,000 in that, and let's say you need $100,000 of income to qualify, you just call up your investment advisor and say, I'd like to create a standing order for $100,000 per year divided by 12, whatever that number is. And then you have to take one draw on that. And all you need for underwriting purposes is to show you that you took a draw, to show that you have a standing order for that amount monthly, and then to show you that you can sustain that for 3 years based upon the balance in that account. And there's no responsibility or obligation for you to continue that after you close on the loan. Nobody's requiring you to commit to the same job, the same type of income. They're using your history or your assets to predict future income, but it doesn't constrain you in terms of what you do after closing. So you don't have to continue drawing that IRA out for the next however long. So that's it. Thanks so much.